Welcome to the deep dive. Today, we are strapping in for a really intensive look at a company that was, for years, just the darling of the building materials sector.
Trex Company, Inc.
Trex Company, ticker TREX. I mean, if you've ever walked into a Home Depot or Lowe's thinking about upgrading your backyard, you absolutely know this brand.
Oh, for sure.
For more than a decade, Trex was really the poster child for a high-quality, high-growth business. It was fueled by one sort of undeniable truth.
The slow, relentless, structural conversion of the decking market.
Right. Away from traditional lumber and toward these low-maintenance composites.
That's right. The investment thesis was, well, it was elegant in its simplicity. You had Trex with the leading brand, the best technology, and they were just perfectly positioned to capture every single ounce of that market share shift.
The inexorable conversion.
That's the term we always heard. An inexorable conversion. They were a secular growth star. But the moment we are really analyzing today is the second half of 2025.
And that's where that simple, beautiful narrative completely broke.
It didn't just break.
Yeah.
I mean, you could say it shattered.
It really did. It shattered under the weight of these unforeseen pressures. And we are now standing at a critical inflection point. The whole mission of this deep dive is to answer the question on everyone's mind.
Is this temporary or is this permanent?
Exactly. Is Trex facing a temporary cyclical speed bump caused by, the macro environment? Or is this a permanent impairment, something driven by fundamental structural changes in their operations and the competitive landscape?
And because of that, the entire investment thesis has been forcibly transitioned. It went from a pure growth story to something very different.
A cyclical growth at a reasonable price thesis, a chart thesis. So
Okay.
you have to understand the risk of the cycle now before you can trust the growth story again.
And to appreciate just how severely that shift is testing the company, you first have to understand what they were dominating. I mean, Trex commands an estimated 40 to 50% share of the entire composite decking market.
Which is just staggering.
It is. Their dominance is rooted in this highly effective defensive competitive mechanism. We call it the vice grip moat.
The vice grip.
Uh,
Okay, what are the two parts of that?
So that vice grip combines two almost unassailable forces. First, consumer brand recognition that is nearly unparalleled in the sector. We're talking over 90% consumer awareness.
30%.
And second, a deeply entrenched, almost exclusive professional distribution channel.
So a moat that strong should be able to withstand in any single shock, right? But the sources we've analyzed show that in 2025, it wasn't one shock, it was three.
Three separate massive developments that didn't just hit one after another, they collided simultaneously.
Creating a perfect storm.
A perfect storm that tested the very resilience of that moat.
So what were those three shocks that just defined the year for them?
Okay, so you have three distinct levels of risk hitting all at once. The first and the most immediate pain point was the macro environment.
The R&R market.
A sudden and severe repair and remodel market slowdown. And this is a massive issue because over 85% of Trex's revenue comes from these discretionary homeowner projects.
Okay, that's shock number one.
The second shock was operational. You could say it was self-inflicted, but it was probably unavoidable. The company's largest ever capital expansion.
The Arkansas facility.
That massive $450 million plus Arkansas facility came online right as demand collapsed. That created huge friction and inefficiency.
And the third one, the structural threat.
This one emerged in March of 2025. The building giant James Hardie acquired Trex's main rival, Ezek.
Instantly creating a formidable, well-funded, new competitive entity.
All three of those together are why Trex is now navigating the most challenging period in his modern history.
Okay, let's unpack this moat then by starting with the company's DNA. We need to trace their history to really appreciate how they became so resilient in the first place.
It's a great place to start.
The Trex story is, well, it's actually a redemption story. It started back with tech developed by Mobil Oil in the early 90s, went public in 1999. But that first decade was not the smooth sailing we often associate with them now.
That's a really crucial distinction. Trex went through what they now call their dark stretch.
Their dark stretch.
Roughly between 2008 and 2012. And this period was, it was almost fatal. They were battling constant, significant product quality failures, mostly related to surface integrity.
So what are we talking about here? Like, what was actually wrong with the decks?
We're talking about early composite decks suffering surface flaking, severe mold, discoloration. These weren't just aesthetic issues. These were functional defects.
Which led to lawsuits.
Directly to multiple class action lawsuits. I mean, think about it. If you're trying to convince a skeptical consumer to pay a premium to abandon wood,
And your product is literally degrading and flaking apart in the sun.
it creates an almost unimaginable brand liability. It was an existential crisis.
So what was the pivotal innovation that pulled them back from the brink? What launched the modern Trex we know today?
It was the 2010 introduction of the Transcend line, and specifically the concept of the capped composite.
Capped.
Right. Before this, the internal composite core, that mixture of wood fiber and recycled plastic, was just exposed to the elements. Transcend introduced a polymer shell coating,
It's like a durable shield.
essentially a durable, non-organic vinyl shield that wrapped around the composite core. This polymer cap sealed the core, which solved all those legacy issues: moisture absorption, staining, surface degradation.
And that resurrected the brand.
It completely resurrected the brand's reputation and validated the high-growth trajectory they were on.
And once they perfected that cap technology, they were able to deploy it in a sales strategy that was really designed for margin expansion and total market capture.
The good, better, best hierarchy.
Exactly. So how is that strategy designed to lure consumers away from wood?
The structure is really strategic. So the lowest barrier to entry is the good line. That's Trex Enhance. This line uses techniques like scalloped boards, meaning they actually remove material from the underside to keep the cost profile down. It's positioned at roughly a 2 times price premium to traditional pressure-treated lumber.
So that's the lure.
It's the crucial primary lure. It serves 2 purposes. It gets the price-sensitive consumer to make the leap away from wood, and it gets the contractor comfortable installing a Trex product at a lower price point.
So they sacrifice a little margin on the enhanced line to get the market converted, and then they leverage that brand trust to move the consumer up the value chain.
Precisely. The goal is always to move them toward the mid-range, select, and especially the high-margin, top-tier best lines.
Transcend and Trex signature.
That's where the serious profit resides. These premium products feature the most advanced technology, including proprietary heat-mitigating formulas, which are essential for composites in direct sunlight superior scratch resistance and the best aesthetics.
And the warranties reflect that.
These lines are backed by industry-leading 50-year limited warranties. It's a sign of their absolute confidence in that capped technology.
This brings us back to the core economic argument against wood, which, I mean, it still commands 75% of the market volume.
A huge amount.
So they are not competing on day one pricing. It's about value over time. What does Trex total cost of ownership, or TCO, argument actually look like?
It's the classic battle of maintenance versus longevity. A wood deck is cheap up front, but it requires significant recurring investment.
All the staining and replacing boards.
Exactly. Over 25 years, you have to factor in the cost of annual or biennial cleaning, costly restaining, replacing damaged or warped boards, and all the labor involved in that.
So what's the bottom line number?
Trex estimates that over a typical 25-year lifespan, the length of their standard warranty, their total cost of ownership is less than half that of a traditional wood deck.
Less than half.
And not only is the long-term cash outlay lower, but you also eliminate that intangible cost of time, effort, and hassle. That TCO proposition is the engine that drives the secular wood conversion trend.
That makes perfect sense from the consumer side, but I have to ask, if they're building a premium product that has superior longevity, how do they maintain a structural cost advantage? Surely using high-quality polymer caps and recycled materials isn't automatically cheaper than just a simple lumber.
And that's where the paradox and the true brilliance of their moat really lies. They managed to deliver a premium TCO while simultaneously operating with a structural cost of goods sold at cost advantage.
And that comes down to their supply chain.
Their vertical integration, specifically. Trex products are famously made from 95% recycled content, reclaimed wood fiber, and crucially recycled polyethylene film, PE film.
The plastic used in grocery bags and stretch wrap.
Exactly. Grocery bags, stretch wrap, dry cleaning films, you name it.
And how deep does that integration go? We heard they source from thousands of locations.
It's absolutely massive. They operate a highly sophisticated proprietary recycling operation. They source that PE film from a vast network of over 32,000 collection points.
32,000.
Grocery stores, retailers, schools, distribution centers. But what's really critical is their proprietary reprocessing technology. They can clean and process low-cost, even slightly contaminated recycled material that their competitors often can't.
So if a rival has to use more expensive, cleaner material,
If a rival has to rely on more expensive virgin or higher-grade recycled PE, Trex instantly gains a Ganges advantage that is difficult, if not impossible, to replicate without decades of similar vertical investment.
so they have a superior product, a compelling TCO argument, and a locked-in cost advantage. That returns us to the second half of that vice grip, the distribution channel. How exactly does Trex lock in the distributors and those 6,700 professional dealers?
This is the genius of the brand pull plus channel push model.
Pull and push.
The pull is the consumer. 90% awareness means homeowners walk into a lumber yard demanding Trex by name. The professional contractor has to carry it, regardless of incentives from other brands.
Okay, that's the pull. What's the push?
The push is how Trex manages its two-step distribution model, from wholesalers to the pro dealers. They use sophisticated volume rebate programs, loyalty incentives, long-term supply contracts. The switching costs for these dealers and distributors are prohibitively high.
Because their business depends on it.
Essentially, yeah. Their business model depends on stocking the product the customer demands. If a dealer stops carrying Trex, they instantly lose a huge volume of highly profitable business to the dealer across the street. That creates incredible channel inertia.
And that channel lock-in is why, for that whole decade, from 2014 to 2024, they were able to generate a revenue CAGR of 11.4%.
And net income grew even faster.
At an 18.3% CAGR. That just demonstrates pricing power, operational leverage, and a truly world-class business model.
That's the foundation. Now let's see how quickly and how violently that stability was upended by the cyclical forces of 2025.
Here is the tale of two halves, and this is where it gets really interesting because the downturn was just so sudden. Trex finished 2024 strong, boasting a 31.3% adjusted EBITDA margin.
Huge margin.
They carried that momentum right into the first half of 2025, even beating analyst expectations in Q2.
The confidence level was, it was sky high. Think about this. As late as August of 2025, management was still reaffirming their full-year guidance.
Wow! In August.
They were telling the market to expect 5 to 7% revenue growth and an adjusted EBITDA margin above 31%. They truly believed their secular growth trend could shield them from any lingering macro weakness.
But the reality was dramatically different. The Q3 crash on November 4th, 2025 hit like a sledgehammer.
It did.
Revenue came in at only $285 million, missing consensus estimates of around $301 million. The market's reaction wasn't just disappointment, it was panic.
It was visceral. The stock price collapsed as much as 31% intraday.
31%.
That kind of sharp, violent revaluation means the market is instantly shifting its thesis. The simple growth story is dead, and now risk is the only topic of conversation.
So what was the official diagnosis from management for this total and sudden reversal?
They pointed squarely at external factors. Specifically, a sudden and rapid weakening in the core repair and remodel market sentiment.
Weaker than anticipated.
That's the phrase they used. Because decking is so discretionary, over 85% of their business, even a slight reduction in homeowner confidence can lead to projects being put on ice. This core macro slowdown was then severely amplified by their distribution channel partners,
Who reacted by destocking.
aggressively destocking inventory.
Let's nail down the numbers on the damage. They went from predicting 5 to 7% growth to flat revenue and a significant margin cut.
The revised guidance was severe. Full-year 2025 revenue was cut to approximately flat, and the profitability outlook was slashed entirely. Adjusted EBITDA margin guidance dropped from exceeding 31% down to a dismal range of 28.0 to 28.5%.
That is a serious compression of profitability for a company that's just used to continuous margin expansion.
It's a huge hit.
This raises a fundamental question for a growth-oriented company like this. Why is Trex so profoundly sensitive to the cyclical fluctuations of the R&R market?
Well, it really comes down to financing mechanisms. A deck replacement or addition is a large ticket item. Often $10,000 to $30,000 for a composite deck.
Right.
Homeowners usually finance these projects using cash, savings, or more commonly, a home equity line of credit, a ECLOC.
And when interest rates are high.
When the Federal Reserve maintains high interest rates, the cost of borrowing via ECLOCs skyrockets. Suddenly, a $20,000 project that seemed manageable becomes prohibitively expensive on an installment basis. This immediately causes homeowners to defer the project indefinitely.
So the high interest rate environment is a direct killer of discretionary R&R spending.
And Trex is caught squarely in the crosshairs.
And the pain is amplified by the very mechanism we just praised, their highly efficient distribution channel. We call this the bullwhip effect. Can you elaborate on why their revenue is so much more volatile than actual consumer purchases during a downturn?
Certainly. So imagine the whip starting at the consumer end. Let's say demand slows by 5%.
Okay.
The distributor or the dealer, aiming to preserve capital and reduce their inventory carrying costs, they don't just cut their orders to Trex by 5%, they cut them by 15 or 20%.
A burn through what they already have.
To burn through their existing stock and manage risk heading into the end of the year. This rapid, exaggerated reaction at each stage of the supply chain, the distributor, the dealer, that is the bullwhip effect. It means Trex's sell-in revenue becomes dramatically more volatile than the true sell-through, the end-user demand.
But wait a second. If their brand pull is 90%, if the consumer demands Trex by name, why can't Trex just dictate terms to their distributors and force them to maintain higher inventory levels and smooth out this volatility? Isn't the acute nature of the bullwhip effect a hidden weakness in their channel push dominance?
That's a really sharp challenge, and it reveals the inherent trade-off in the distribution model. While Trex has immense brand power, the channel partners are independent businesses. They operate on razor-thin margins, and they prioritize working capital.
They can't force them.
Trex can incentivize them, but they cannot legally dictate their inventory levels. And when demand falls off a cliff, forcing the channel to hold expensive inventory risks, damaging those long-term relationships.
The very same relationships that make up the push side of the moat.
Exactly. So Trex has to allow the destocking to happen even if it violently depresses their own short-term revenue to maintain the structural integrity of that channel long-term.
That makes the margin miss even more painful because it was compounded by a failure in their own internal planning. Tell us about the level loading production program that backfired.
Right. So management introduced this level loading strategy to boost operational efficiency. Typically, decking manufacturing is highly seasonal. You ramp up capacity dramatically in Q1 and Q2 to prepare for the peak spring and summer demand.
Right.
Level loading aimed to smooth production throughout the year, running machines consistently to maximize throughput and minimize costly cyclical hiring and layoffs. This strategy was sound.
Provided demand remains stable and strong.
Exactly, as management forecast it would back in August.
But the R&R market didn't stay stable.
No, it didn't. When the market unexpectedly weakened in Q3, that level-loaded production instantly created an inventory glut. Suddenly, Trex was sitting on high levels of finished goods inventory just as their channel partners were refusing to buy.
So they had to cut production.
It forced management to make sudden, reactive, and highly inefficient production cuts. Think emergency plant shutdowns, temporary layoffs later in the year. These unplanned cuts eroded efficiency and drove up per-unit costs, directly contributing to that severe EBITDA margin miss.
A classic operational strategy built on a macro forecast that turned out to be disastrously wrong.
And now we transition from the immediate cyclical pain to the long-term changes that will define Trex's decade ahead. These are the structural challenges.
We have to start with the operational beast, the new Little Rock, Arkansas facility. This is a massive commitment, over $450 million in capital investment. It was designed to support sales capacity exceeding $2 billion.
It's huge.
Why is this facility coming online at the worst possible time, and what does it actually add to the company?
Well, this is the critical cyclical mismatch. The facility itself is state-of-the-art. It adds highly automated, massive new extrusion lines, significantly expanding their overall manufacturing footprint. And crucially, it also includes a major expansion of their proprietary PE film recycling capacity.
Reinforcing that structural COGS advantage we talked about.
But because they financed this massive investment based on the expectation of continuous, strong growth, they are now stuck with a gigantic new asset that is ramping up just as overall demand is shrinking.
That sounds like a long-term benefit, but a massive short-term drag. Can we quantify the pain this facility is inflicting on them right now?
We can, and the numbers are pretty specific. Beyond the several $1 million in startup costs they already incurred in COGS and SG&A through Q3 of 2025, the real structural headwind hits in the full year 2026 forecast.
Okay.
Management explicitly guided that the new depreciation expense alone which is just the accounting charge for the use of this new, expensive, underutilized asset, will create a 250 basis point drag on gross margin throughout 2026.
A 250 basis point hit is huge. So if their core margin was, say, 40%, it'll now be forced down to 37.5% just because of an accounting charge on capacity they aren't even fully using yet.
Precisely. That margin compression is guaranteed, regardless of whether demand stabilizes next year. It's the mathematical cost of investing $450 million. The facility's capacity is revenue neutral in the short term, but it is depreciation heavy.
So the whole bullish argument relies on them growing into that capacity.
The entire long-term bullish argument relies on Trex surviving 2026 and then growing into that capacity rapidly enough to eventually reverse that drag and generate significant operating leverage. Until then, it's a guaranteed headwind.
But the Arkansas issue, while painful, is self-inflicted and temporary. The other structural change, the competitive shift, is external and potentially permanent. Let's talk about the James Hardie acquisition of EZEC for $8.75 billion in March of 2025.
This is the big one.
This is the first time Trex has faced a competitor this formidable.
This is truly a game changer. James Hardie is an elite operator. They are the dominant category killer in fiber cement siding, known for relentless operational efficiency and execution. By acquiring EZEC, Trex is no longer competing against a smaller, specialized decking rival.
They're competing against a multi-billion-dollar, vertically integrated behemoth.
A behemoth that understands the pro-contractor channel better than almost anyone.
And what's fascinating here is that James Hardie achieved its dominance in the siding market using the exact same competitive playbook.
A brand pull and channel push vice grip.
The same one that Trex perfected in decking. They understand the power of the moat they are now attempting to breach.
And that's the entire strategic risk. The new merged entity's rationale is built on capturing what they call significant commercial synergies.
Which means bundling.
It means bundling. They want to sell their dominant fiber cement siding products alongside EZEC and TimberTech, decking through the same professional distribution channels and to the same contractors.
So for the first time, a pro contractor has a credible incentive to choose a rival decking product.
If it comes bundled with their preferred and likely deeply discounted siding material, this directly challenges the exclusivity and the lock-in of Trex's channel push.
Let's just briefly touch on the product difference again, because it's often a point of competitive messaging. Trex uses wood polyethylene composite, leveraging its recycling mode. EZEC is different.
Right. EZEC's premium TimberTech lines are made from 100% PVC polyvinyl chloride. EZEC historically promoted this as an advantage, claiming it was lighter, structurally superior, and cooler to the touch than standard composites.
Net Trex has countered that.
They've countered it effectively. Their latest premium lines, like Transcend, Lineage, and Signature, incorporate proprietary polymer shell formulas specifically designed for advanced heat mitigation. So Trex has ensured that the material advantage of PVC is largely neutralized at the high-end tier.
So the battle is shifting.
It's shifting purely to brand, channel control, and pricing strategy.
And finally, we noted a critical management transition right before the November crash, the appointment of a new CFO, Prithvi Gandhi.
The timing is highly significant. He was appointed on October 1st, 2025, just 34 days before the severe earnings miss and guidance revision.
And what does that signal?
In corporate finance, a change in CFO often precipitates a period of intense internal scrutiny, financial restructuring, and frequently it leads to a clean-the-slate event.
Where you clear out old inventory, recognize costs.
And reset expectations for the future. While it's necessary, this transition adds an element of organizational transition risk and uncertainty on top of the already severe market and competitive risks Trex is facing.
We have spent a lot of time on the challenges, but we have to return to the fact that Trex is fundamentally a high-quality business. Despite the severe challenges of late 2025, the historical financial track record and the current balance sheet suggest resilience. Let's just recap that stability.
The historical performance is really the bedrock of the bullish case. Over the 10 years leading up to the 2025 shock, that 11.4% revenue CAGR was impressive.
But the net income growth was even more impressive.
The 18.3% net income CAGR is the proof of quality. It shows consistent operating leverage, where profits grew significantly faster than sales, indicating strong pricing power and highly disciplined cost management. That DNA doesn't just disappear overnight.
And crucially, they entered this downturn with minimal financial distress. How strong is the balance sheet?
Extremely strong. They operate with very low leverage. As of the end of Q3 2025, they had only about $111 million outstanding on their revolving credit facility.
Which is a huge asset in a
It's
downturn.
a massive asset. It means they have the financial flexibility to weather the storm, continue the Arkansas ramp, and even pursue opportunistic share repurchases without facing liquidity crunches or resorting to expensive high-interest debt.
They are also a cash flow machine, which is critical during a heavy capex cycle. They managed to self-fund the majority of the Arkansas build-out this year.
They did. Year to date through Q3 2025, they generated a robust $292.6 million in cash from operations. And this cash generation was sufficient to fully cover the hefty $188 million in capex during that period,
So the company is essentially self-funding a $500 million expansion.
without stressing the balance sheet. And while this phase temporarily consumed 64% of their operating cash flow, management expects capex spending to normalize significantly in 2026, which will free up substantial cash again.
Let's discuss a critical indicator for long-term investors. Return on invested capital, or ROIC. We are seeing a significant decline here, and it's mathematically tied to that Arkansas investment.
This is the metric to watch. Historically, Trex was exceptional, operating with ROIC routinely in the 25 to 35% range.
Which means they were highly effective at turning capital into profit.
Right. Recently, that figure has fallen to the mid-teens, around 14 to 16%. And if we look closer, this decline is the direct mathematical consequence of the Arkansas investment.
Explain that.
ROIC is calculated as net operating profit divided by invested capital. When you suddenly add $450 million in invested capital, the denominator, before that capacity generates meaningful profit, the numerator, the resulting ratio, has to fall.
So the ROIC dip isn't a sign that the underlying profitability of the business is suddenly worse.
No, it's a sign that the investment phase is currently depressing the metric. It's an unavoidable, temporary penalty.
The success of the long-term thesis hinges on whether they can reverse that.
Exactly. Can they fully utilize the Arkansas capacity, and are the incremental earnings high enough to drive ROIC back towards its historical 25% plus level? If ROIC remains stuck in the mid-teens long term, it signals that the $450 million was fundamentally a poor capital allocation decision.
Moving to shareholder returns, Trex doesn't pay a dividend. It prioritizes organic growth and opportunistic share buybacks. We saw a powerful signal regarding buybacks right after the collapse.
We did. They had prudently paused buybacks for most of 2025 to conserve cash for the Arkansas construction. But immediately after the stock plummeted in November 2025, the board authorized a brand new $50 million share repurchase program.
That's management speaking with their balance sheet.
It's a very clear signal of conviction that the market has fundamentally overreacted and that the stock is undervalued at current prices. They're using the cyclical trough as an opportunity to acquire high-quality assets, their own shares, cheaply.
Let's discuss that valuation trough. The stock experienced extreme multiple compression, which really defined the depth of the panic.
The PE ratio, which reflected all that high-growth excitement at the start of 2025, was trading around 33 times earnings. By mid-November, following the guidance cut, that multiple plummeted to approximately 17 times.
And historically, for a business with Trex's quality and market position, 17x PE is considered a cyclical trough.
It's firmly a cyclical trough or a distressed multiple.
So what does a 17 times PE imply about the market's current expectation for Trex?
The market has fully priced in the bad news. The flat revenue for 2025 and the severe 250 basis point margin headwind for 2026. The 17x valuation is the market looking over the valley.
Meaning they think it's temporary?
It implies that investors expect the downturn to be temporary, that while the next 2 quarters will be painful, earnings will quickly return to a growth trajectory, allowing the PE ratio to naturally expand back toward the mid-20s.
So if the market believed the threat was permanent...
If the market truly believed the margin compression or the competitive threat from JHX-AZEK was permanent, that multiple would sit much lower, likely in the 12 to 15 times range, pricing in a structural long-term failure.
So what profile of investor is Trex suited for in late 2025?
Trex is no longer for the quick turnaround trader. It has transitioned into a thesis stock. It's best suited for investors with a long-term, 3 to 5 year time horizon who possess high conviction in that secular wood conversion trend.
So you're buying a high-quality asset at a distressed price.
But you must have the emotional resilience to navigate significant volatility throughout 2026 as the Arkansas drag and all the competitive noise play out.
We have outlined the perfect storm. Now we must look at the paths forward. Let's start with the bull case, the optimistic path where Trex's moat holds and the long-term thesis is validated.
Okay, the bull case is built on three pillars of recovery. First, that the R&R slowdown is proven to be purely cyclical.
Just a temporary blip.
Right. This assumes that when inflation moderates, and more importantly, when interest rates eventually moderate in 2026 or 2027, consumer confidence will return, and all the deferred, pent-up demand for deck projects will be unleashed.
And the second pillar relies on their giant new operational asset fulfilling its promise.
It becomes the coiled spring. Once demand returns and capacity utilization at the Arkansas campus ramps up from current depressed levels, the facility delivers sharp, massive operational leverage.
The drag becomes a tailwind.
The 250 basis point drag reverses into a tailwind. Efficiencies drive costs down, margins restore toward 30–32%, and ROIC quickly returns to the historical 25% plus range. The investment, which looks painful now, proves to be perfectly timed for the next decade of growth.
And finally, the moat must hold against the new competitive giant, JHX AZEK.
The moat holds because Trex consumer brand pull is simply too powerful. Decades of brand building translate into instant trust, which contractors can't overcome even with bundling incentives.
And they have that big box advantage.
Furthermore, Trex maintains a critical channel advantage. They are the only brand stocked on shelf at both major big box retailers, Lowe's, and Home Depot. AZEK and TimberTech typically require special ordering. This on-shelf dominance creates immense inertia and friction for any challenger trying to gain market share.
That is the optimistic view. But the bear case, predicting a permanent deterioration, is equally compelling given the new threats.
The bear case is also defined by three pillars. First, the R&R freeze proves to be structural. The high interest rates persist for much longer, higher for longer. And the rate lock-in effect, where existing homeowners refuse to move or refinance, leads to years of stagnation.
A prolonged period of flat or minimal spending.
Which would crush Trex's historical growth potential.
The second is the success of the competitive erosion.
This is the most damaging long-term threat. The JHX AZEK bundle successfully leverages James Hardie's vast professional channel to break Trex's existing exclusivity. By forcing contractors to choose a cheaper, integrated siding and decking solution, they fragment the market.
Which forces Trex to compete on price.
And that permanently lowers its sustainable gross margins below 40%, making it impossible for them to achieve the historical 31% plus EBITDA margins. The vice grip is broken.
And the third risk is tied directly to the execution of that capacity ramp.
That's the management execution risk. Amid the soft market and the new CFO transition, the Arkansas ramp could be mismanaged. Persistent inefficiencies, supply chain glitches, or an inability to fully utilize the capacity lead to prolonged cost overruns and operational issues.
So instead of a coiled spring,
the $450 million investment becomes a long-term anchor, persistently impairing ROIC below the cost of capital.
So if you, the learner, are watching this company through 2026 and 2027, what are the four most actionable metrics and signals you should be tracking to determine which path bull or bear is materializing?
You need immediate, high-frequency data points. First, monitor channel inventory commentary. Listen very closely for management signals regarding their distributors and dealers. The key signal of recovery is distributors actively restocking.
Restocking is good.
If the commentary indicates continued pressure for channel partners to destock, it means the downturn is still deepening.
Second, we need to strip away the noise of the Arkansas depreciation to see the true strength of the core business.
Exactly. You must track and model the core gross margins. That means assessing the profitability, excluding the estimated 250 basis point depreciation headwind in 2026. This core margin is the truest test of Trex's pricing power against the new JHX AZEK entity.
If it collapses, the threat is real.
If the core margin starts collapsing, the competitive threat is real. If it holds firm above 40%, the moat is intact.
Third, what external economic data provides a leading indicator?
You have to look outside of Trex's financial statements. Follow the external data on homeowner spending and confidence. Key leading indicators include mortgage rate trends and, specifically, the Harvard Joint Center for Housing Studies IRA.
The leading indicator of remodeling activity.
Right. When the LIRA index stabilizes or shows signs of accelerating, you can anticipate relief for Trex about 3 to 6 months out.
And finally, the direct threat. What competitive signal should we watch from the new rival?
Monitor every announcement from James Hardie and AZEK. Look for specific competitive signals regarding aggressive bundling programs, volume rebate increases aimed at Trex dealers, or the nuclear option.
The big box stores.
Any major announcement about gaining better dedicated on-shelf status at Home Depot or Lowe's. If JHS ASIC manages to fundamentally change that big box channel dynamic, the structural threat escalates immediately.
This deep dive into Trex has proven that even the most established secular growth stories are not immune to market volatility and competitive pressure. We started with a high-quality company defined by a superior brand, a resilient cost structure, and a formidable distribution mode.
But now they're in a massive fight.
They're currently engaged in a massive strategic battle on three fronts: fighting a severe cyclical slowdown, absorbing the operational drag of the enormous Arkansas capacity ramp, and defending their channel dominance against the first truly credible structural competitor in the James Hardie-Izek combination. The long-term trend of converting wood to composite remains sound, but the next 18 to 24 months will be a bumpy, volatile, and highly scrutinized journey.
And that leads us to the final provocative thought for you to consider. The composite decking category is projected to grow aggressively, potentially seeing a 16.6% CIGR over the next few years, as wood, which still holds 75% of the market volume, continues its slow decline. Trex's success has always relied on the TCO argument, convincing the homeowner that longevity is worth the initial 2x price premium. Now, given the new James Hardie-Izek combination, which can leverage its dominance in siding to push its decking hard through the professional contracting channel, we have to ask this question. Will the consumer's deep-seated brand loyalty and demand for a branded, low-maintenance product like Trex continue to outweigh the contractor's commercial incentive to buy a potentially cheaper integrated bundle system from the new JHX AZEK powerhouse? The answer to that question defines who truly owns the future of the American deck.